All right. Well, thank you all, and welcome to everybody that's here, and appreciate you coming today. My name is Jason Hyde, and one of the presenters here. I'm a financial advisor and partner, and I'll here with Moneco Advisors, and I'll introduce my other partners to you in a moment. This webinar is being recorded. If I move my cursor, you'll be able to see a little Q&A button down at the bottom. So we can't see you or hear you. By the way, that this Zoom presentation is set up. But if you do have a question throughout the presentation, we're going to take some time at the end of the presentation and go through them and try and answer all of your questions. I just want to start off by saying, and most of you are already clients, but so Moneco Advisors was founded in 1980, and when I got here 11 plus years ago, I was the 12th person here at Monaco, and today we're over 70. So there's five of us that are going to be doing this particular presentation today. Few of my partners that are going to be presenting: Peter Osborne, Colleen Galushko, Bill Brancaccio, and then AJ Kelleher. And today we're going to be addressing the U.S. debt situation. And it's a topic that's grown a lot more popular, particularly since the pandemic, when the debt really spiked even further and more acutely than it had in the past. So, but one of the things that we wanted to start off with is because a lot of the things that you're going to hear today is going to be a little bit startling, but where there's crisis, there's also opportunity. And so we're going to make sure to talk about that at the end, um, and where those opportunities might be, and what our thoughts are about that. So Peter's going to get things going with an overall summary of where things are with our debt situation.
Okay, well, thank you, Jason. And let me start by saying that we are financial advisors, not political advisors. Okay, this presentation is meant to give you data on the current debt situation and the investment implications thereof. And despite what some of you might think, this is not necessarily going to be about gloom and doom. So sorry to disappoint anybody who was hoping for that. And I want to start with some terminology, just so we all know what we're talking about here. Um, GDP, gross domestic product. This is a metric that economists use to measure the size of a country's economy. And in its most simplest form, it is the total market value of all goods and services produced within a country's borders. And for your reference, the GDP of the United States of America for 2025 was $30.5 trillion. There's another term I'd like to introduce you to, and that is called the debt to GDP ratio. This is a ratio that compares the level of our debt to the level of our economic output. So let's put a pin in that for a second. I want to take you back in time. February of 1989. That's when the Times Square debt clock was installed, actually a block away from Times Square. At the time, the country had just crossed $2.7 trillion in national debt. And by way of comparison, today we're at 37.4. Back then, when the clock was installed, that debt to GDP ratio that I mentioned was 50%. Today, that statistic stands at 119%. And many economists believe that that will rise to 156% by the year 2055, given our current fiscal trajectory. And To give you some historical perspective um, on debt to GDP, in 1960, the ratio was 53.33%. In 1980, it declined to 34.5%. And in the year 2000, it was at 59.58%. So with today's metrics, we're really double where we were in the year 2000. And since the debt levels is so historically high, there are 4 points on this slide that I want to discuss and make you aware of. Um, Point number one, interest payments on our debt are now the third largest federal budget expense item, coming in at $952 billion per year. And that works out to $2.6 billion dollars per day in interest. And right now, we're spending more money on interest as taxpayers than we're spending on national defense. Um, Point number two, foreign holdings of our debt have been declining. Um, Foreigners owned 50% of the US debt back in 2013, and that number has declined to current level of about 30%. This is significant because the US is a net importer of goods. Countries who are importers need to finance that debt somehow, and that debt has to be financed by foreigners, and that's to make the balance of payments work. Um, Point number three, in 2025, we experienced what was called a maturity wall. The U.S. Treasury had approximately $9.2 trillion in debt maturities during the year that had to be reissued or, refinanced. And despite the fact that the Federal Reserve started cutting rates last year, so interest rates were going lower, the rate on the U.S. Treasury by year-end 2025 was higher than it was at year-end 2024. And I'm not going to go into a lot of this right now, but Bill is going to pick this up a little bit later in the presentation. And point number four is our credit rating. Historically, U.S. Treasury obligations have been considered the gold standard and the safest place to invest your money. They'd always been AAA rated. Uh, in 2011, Standard & Poor's, who is one of the three major rating agencies, lowered the U.S. credit rating, and since then, the other two major credit rating agencies have followed suit. So we are no longer AAA rated status. And I found an interesting fact. Um, our debt first hit $1 trillion on October 22nd, 1981, and has since grown to over 37 trillion given the past over the past 45 years. If you had, as an investor, if you had invested money into treasury bonds back in 1981, from then until present, you would have realized a rate of return of 7% on your investment. For the same period of time, the rate of the increase of our debt has been 8.7% a year. So essentially, an investor would have been better off if there was some way they could have invested in the growth rate of the debt rather than investing in the debt itself. Sort of interesting. Jason, could you move forward to the next slide, please?
Yep, here it is.
Thank you. So, what does all this mean to you? Um, but first, we'll do some more terminology quickly. Um, we want you to understand the composition of the federal debt. So the gross federal debt, that is the total amount of money that the government owes. And presently, it's broken out into two categories. So $30.1 trillion is publicly held debt. That's U.S. Treasury bills, notes, and bonds. So that's the actual money that is owed to creditors. There's another 7.6 trillion in what is called intragovernmental debt. And these are, for the most part, IOUs to Social Security and Medicare. And if we do a little math, given the level of total debt, each household's share of that debt is $283,000. Breaking that down further, each American share is $110,000. So that's the share each and every one of us on this call shares today. Can you move forward, Jason? And as I mentioned 2 slides ago, the current U.S. debt to GDP ratio is 119%. The last time it was this high was the end of World War II. In 1941, as we entered the war, the ratio was at 42%. And then by the time we exited the war, it was up to 114%. When the war ended, a massive economic expansion started as industries transitioned from a wartime economy to a peacetime economy that was further driven by the baby boom and massive population increases. The debt we have today has increased during a peacetime economy, really as a means to maintain economic competitiveness and compensating for our declining global position. And question I have is, are we an expanding economy like we had post WW2, or is this a contracting economy? And what impact will the wartime-like spending we're seeing on artificial intelligence have on all this? And we're going to address this a little bit later in the presentation. But I want to point out that we're not the only ones with debt issues. Japan currently has a debt to GDP ratio of 250%, which is more than double what our ratio is. And they have been using massive stimulus packages to combat economic stagnation since the early 1990s. And the debt to GDP has been elevated for a long time. However, Japan is a net exporter of goods, and 90% of their debt is owned by Japanese savers. But who owns our debt? And I'm going to pass this over to Colleen, and she's going to talk more about who's holding our debt. Colleen?
Thank you, Peter, and welcome everyone. As Peter mentioned, yes, who owns the debt today in America? Well, that 30.1 trillion publicly held debt it's varied across a number of different creditors. The foreign governments account for $8.5 trillion of the debt, which is 28%. Domestic private investors, that's diversified between pension funds, insurance companies, mutual funds, banks, and individual investors. That accounts for $17.4 trillion, 58% of the public debt, the biggest part. The Federal Reserve is now at $4.2 trillion, which is 14%. Our creditor base has evolved significantly, as Peter already pointed out, since the financial crisis. The Federal Reserve held minimal Treasury securities before 2008. And what happened in 2008? We had the financial crisis. So what did the government do? They made money out of thin air, and they purchased massive amounts of treasuries and mortgage securities to keep interest rates low and to inject liquidity into the market. We saw domestic demand increase while our demand for the foreign demand actually decreased. And on to our next slide. We're going to talk now about the spending side. Where is the money going? Well, there's 3 categories that consume over half of the expenditures. Social Security is number one. $1.35 trillion is being spent on Social Security payments. That's 20.3% of the spending. Medicare is at 1.02, closely following behind with 15.4% of the spending. Net interest on payments, $952 billion. It's the fastest growing component of the budget. All these programs are have increases based on the number of retirees, the cost of living adjustments, healthcare costs, and our aging population. Another program that we have is the defense spending, which accounts for $850 billion, which is large, yet it's still smaller than our net interest payments. On to our next slide is the revenue challenge. So this is where the Federal Reserve has revenues that total approximately 4.35 trillion annually. But it's heavily dependent upon workers' earnings and individual payroll taxes. Corporate taxes once accounted for 25% of the federal revenue, but now only contributes 10%. The tax system's reliance on individual income taxes creates vulnerability to the economic cycles because, let's face it, during recessions, we see unemployment rise, incomes fall, and the dependence on these safety programs increase. With the apparent goal of lowering interest rates, which could lead to higher spending, which is what we hope to happen, our opinion is that the government is trying to outgrow the pace of our debt. Now I'm going to turn it over to Bill.
Thank you, Colleen. So let's take a look at some of the historical milestones that got us here. Each crisis leaves us with a permanent ratchet effect, where the debt level never fully returns to the pre-crisis level. The baseline becomes the new platform for the next crisis-driven expansion. Some of the notable crises that we've experienced were World War II, where debt rose 500% to $259 billion, the Great Recession or Great Financial Crisis, where it increased the U.S. national debt by $3.8 trillion, or a 38% increase. Most recently, the COVID pandemic, which increased the debt by $7.8 trillion, or another 34% increase. There are other notable events that happened within here that created new economic measures, such as Vietnam War, which sharply increased the debt and eventually led to the Nixon shock back in 1971, where the U.S. put an end to convertibility of the U.S. dollar to gold. Furthermore, they changed the definition of the dollar in 1976 to remove the reference to gold. That was a $92 billion increase, or about 50% during that decade. The 1980s saw tax cuts and defense spending, which reversed our previous declining debt to GDP ratio increase, which we saw from World War II to the 1980s. The 2000s had tax cuts in the war on terrorism, which again led to about another 50% increase over that decade before going right into the financial crisis. As the debt rose each time, new financial and economic concepts are put into place. The U.S. became the global hegemony, the U.S. dollar becoming the reserve currency out of the Bretton Woods Agreement, Nixon shock, a change of the gold's role, quantitative easing and tightening, and the creation of modern monetary theory. So of note, as we look at this all from a historical perspective, the increases in debt may have not seemed responsible, but the changes have come from learning from our mistakes in the earlier half of the 20th century, specifically from the Great Depression, that we were able to keep unemployment under those Great Depression levels during these crises, and the economy ended up rebounding fairly soon. So now let's take a quick look at some of the demographic factors that make this a potential future issue. So one of the factors we have to pay attention to is we're not getting any younger. We have 2.4 workers for retirees by 2030, where we used to have 3.4 workers for retirees. Workers supporting more retirees means inevitably higher taxes on workers, reduced benefits for retirees, larger deficits, or some combination of these. It might not look great, but there is one change on the horizon that I'm sure everybody on this webinar has heard way too much about, which is artificial intelligence and how it could change your life. This could be one of the Hail Marys to help the aging population. Artificial intelligence, quantum computing, robotics, can really change some of these dynamics. If we're able to increase productivity of the workforce or lower cost, increase care of delivery and health outcomes, you won't be able to change the actual demographic outcome, but you could reduce the need for entitlements and entitlement spending, specifically around Medicare, and maybe increase in profitability and tax revenue from the working population itself. The 2020s may seem like a decade of inflation. If the outcomes we're expecting from artificial intelligence come to fruition, you may see a wave of deflation in the 2030s, which could inevitably lower borrowing costs across the world. And you may even see things like more efficient energy usages, which might offset some of the fossil fuel costs and increase adaptation to things like nuclear energy and so forth. So now let's see how the interest cost in the US factors in. To put the interest cost itself into perspective, as we sit here today, the US will incur $2.6 billion of net interest expense today alone. Should interest rates on the average US Treasuries increase by a full 1%, that alone will tack on another $300 billion. And we already have $9.2 trillion of US debt that we have to refinance this year alone. We're going to cover something important here, which is the news has had a lot of coverage lately on the Federal Reserve's decision to cut rates. But from what we have seen from the pandemic to now is there may have been a shift in the economic landscape from Federal Reserve-driven economy to monetary policy-driven economy. The Federal Reserve controls the short end of the yield curve, so that's the Fed funds rate. But the longer end of the yield curve is controlled by market forces. So as the Federal Reserve had started cutting rates back in September of 2024, the 10-year Treasury is now 50 basis points higher, sitting at 4.3%. So all they've managed to do is just steepen the yield curve, not bring down the total borrowing cost itself. So this is part of the challenge as we hit a new maturity wall this year. The US dollar is still the world's reserve currency, so even though the debt levels are rising, there's still strong demand from treasuries from foreign investors. Let's take a look at the actual dynamics that factor in. So to look at some of the simple math behind this, we're going to skip over all the complicated theories of double entry bookkeeping and all central bank policies. So if we look at your average interest rate that you're trying to keep below the economic growth rate, and anything that doesn't ends up as primary deficit. So the average US interest rate that we're paying right now is somewhere around 3.3 to 3.4% today. The issue is that GDP has historically been going in the mid 2% range. Q3 this past year was a bit of a surprise, coming in at 4.3. So whatever we can't cover through growth, we have to borrow more, which pushes that debt level higher. So the issue you face is once you cross about 100% debt to GDP, it gets exceedingly more difficult to keep pace with the growth to offset the debt itself. Now, I'm going to kick this over to AJ so he can give us a little bit idea of how it's impacted our actual credit itself.
All right, thanks, Bill. So market perception and credit risk. For over a century, the U.S. held on to its AAA rating. And that, as they put it in this slide, that era of credit perfection has ended. And you can see from the chart here, S&P downgraded us in 2011, Fitch in 2023, and finally Moody's in May of 2025. I think the Moody's quote down at the bottom here is pretty interesting. Persistent fiscal deficits, rising debt and interest burdens, and political gridlock. Okay, so they're saying that the agency specifically cited that we would have debt to GDP ratio of 134% by 2035. That is still 10 years away, and I would be willing to bet we blow that number out of the water in the short term. But why haven't we collapsed if this is how bad everything is and if we're no longer AAA? Well, we have to look at that. The response was very muted. Okay. And what were those reasons? I mean, we've come off the highs on the DXY, but we haven't collapsed. So the dollar remains dominant. Okay, about half or more of global trade is invoiced in US dollars. And that just means we have the deepest, most liquid markets and plenty of dollars to go around the world. Everything gets, not everything, but about 58% of global commerce happens in dollars, which means people have to exchange their currency for our currency in order to trade with another country. There's also a lack of alternatives. Okay, so the fact that the dollar trades about 50% is invoiced in US dollars, but we're only about 10 to 11% of global trade volumes. So obviously there's a lot of dollars floating around there. So that's a big reason. And that is by far the largest. There is not a country close to us that has that kind of float going around the globe. Okay, so moving on to what can we learn from history? And this is where we get into where the rubber meets the road. I love this quote up here at the top. Every empire dies the same way. It exhausts its finance trying to sustain power it can no longer afford. And we can see this throughout history. So we're going to look at, a couple of war situations here. America's World War II success. Coming out of World War II, our debt had soared from 43 billion to 259 billion, 106% GDP. But this financed all the industrial expansion and it dominated post-war manufacturing. We had people being trained on the GI Bill, getting great factory jobs, being able to support people on a one income household. You could support your whole family and live pretty comfortably. The economy was booming, and we had technological leadership in a lot of markets. And we had a demographic boost from how young our population was. The returning vets were in their prime working years. If we compare that to Britain, their debt increased after World War I or during World War I tenfold. But they didn't finance anything good with it. Okay, this was survival, not expansion. They lost their industrial supremacy to the United States. And they liquidated all of their overseas investment. They basically allowed New York to take over the financial leadership of the globe. And their debt service at that time, we're just talking about debt service, consumed 20% of the government revenue, which is just an astounding number. From there, what do we have to maybe combat this? Well, obviously we have a large military commitment. We're in over 70 countries. Okay. Our GDP, our share of global GDP has fallen from 50% to 25%, which is not great, but there has been other rivals. Okay, so the question becomes, as we've been leading up to this, are we a rising or declining power? Okay, or are we somewhere in the middle? The evidence that would say that we're going to continue to ascend is our technological leadership in AI, biotechnology, and space. We do have, as I mentioned, the deepest capital markets and financial innovation. We have demographic advantages versus Europe and Eastern Asian competitors. Okay, they have much older populations than we do. And we also have more people on the younger side of their lives that want to come to the United States. When we look at H-1B visas and our university system, our research ability, these are all very, very good benefits to the United States. Now, what are the things that we're doing wrong? Well, as I mentioned, we have that declining share of global GDP. Okay, we don't invest as much as we should into our infrastructure. Our educational performance has dropped massively over the last, call it 40 years, where we used to be top 5 in science and math. And today I think we're languishing in the mid-20s. Don't quote me on that, but I believe we've been surpassed by many countries who have a much rigorous education system than we do. And as I mentioned, we have, political dysfunction in Washington when it comes to balancing a budget or, trying to save money. Everything's everything needs to be spent, and we don't have room to cut our expenses. As we all know, if we did that in our own households, we would have a very short road. But because we can print money, as Colleen mentioned, and because of the money we've already printed and the deep float that we have around the globe, we're able to get away with this, at the moment. So kicking that over to the next slide, someone's going to talk about the investment implications of this.
Yeah, so this is where we tie everything together, right? And what we're doing for our clients, what we're thinking about, right? So all of this information may seem pretty dire, but as we mentioned in the beginning, that there's opportunities that come from these types of situations, and what we're trying to do is potentially get out ahead of it. There's a comedian named Stephen Wright, and he told the joke. He was the one that said, "I put spot remover on my dog. He's gone now." But he also said, "For my birthday, I got a humidifier and a dehumidifier, and I put them in the same room and let them fight it out." And that's sort of what this feels like to us, because everything that we've talked about today are inflationary pressures, right? More debt, more printing, more money, weaker dollar means the prices of things going higher. So, what do we do about that? And at the same time, we've got some pretty amazing things potentially on the horizon, and we don't think that our clients should be out of growth entirely, but maybe we can pinpoint certain areas of growth where we can be a little bit tactical in that regard. So, if you think back to, well, first of all, this last decade, or the decade of the 2010s, if you put your money in the S&P 500, that was all you needed to do. You did great, right? The Mag 7 or whatever the biggest companies were that carried the S&P 500, they carried your portfolio. You really didn't have to think too much about your portfolio. It did all the work for you. The decade before that, from 2000 to 2010, that was sort of a lost decade for the S&P 500. But now here we are in this decade, and valuations for the Mag 7 are pretty high right now. They could continue to get higher, certainly. It should be a part of your portfolio, or considered as a part of everyone's portfolio. But we do believe that diversification is back, and diversification is important. So, what are some ways that you can diversify a portfolio to protect against what we feel is coming with this massive growth in debt that seems unstoppable and insurmountable, at least for the next number of years? One of the ways is international and emerging market economies, investing there. That hasn't really been necessary. The U.S. markets have outperformed those markets for quite a long time now, but that's an area that you can look at. Real assets, commodities and natural resources, real estate is another area. Bill put in here decentralized finance, which is a super complex thing that we're probably not equipped to talk about all that much, certainly not here. But all of these things can be used to really offer hedges to your portfolio and to bring down some of the risk. As far as the interest rate on your fixed income environment, what you would think here at face value is, if interest rates are going up, it'd be logical to think that it would be best to just stay on the short side of the yield curve, short duration fixed income investments. However, we feel like that interest rates are going to maybe be pretty unpredictable, so you want to stay flexible. The Fed controls, as Bill mentioned this earlier, they control the Fed funds rate. So they control short-term interest rates. And Trump gets his pick of Fed chair starting in May. But the Fed doesn't control entirely longer-term interest rates. So markets do. However, during the first Trump administration, we had quantitative easing, where Colleen talked about that before, where we printed money out of thin air to buy bonds and mortgage-backed securities to bring interest rates down. Anything is possible. So staying flexible in an unpredictable environment would be a worthwhile thing to think of with your interest rates. And then investing in particular sectors. If we feel like inflation is coming, thinking about sectors like energy, real estate, financials that historically do well in inflationary environments would be worthwhile. And then we don't believe that you want to eliminate growth, but including value, more value in a portfolio would be worthwhile, in our opinion, where it has underperformed growth over the course of the past 10, maybe 15 years, certainly, but using value. One of the quotes that we think about often is a Wayne Gretzky quote where he says, "I skate to where the puck is going to be and not to where it's been." And I don't know anything about hockey that much, but I do like the quote, and it's something that as a firm and certainly as a team, people on this call and other people's that are part of our group here, we meet regularly to think about those things and sort of agonize about those things. And we use a risk analysis software program, and we use that to see what our clients' diversification actually looks like, what sectors they're in. And that's the reason why we use it, so that we know truly what the diversification looks like, so that it's not all in just large cap, mid cap, small cap. So um, it's got actual, real, true diversification. So let me just kind of open it back up. I mean, AJ, Bill, Colleen, Peter, am I missing anything about, what we're thinking as a team, as a firm, about things that we can be doing for our clients, right? Because that's the point. We can't control any of this, right? And this may be very bad for the dollar, and this may be very bad for people that don't have assets and that live paycheck to paycheck, because things could get much more expensive in the short term. Maybe, but there's also the idea that down the road, there's things like that Bill talked about. And
Well, yeah, and Jason, just to hop in there too, with the
great.
international positioning, you can invest internationally in developed markets, emerging markets. You could be dollar neutral. You could do local currency if you really expect the dollar to decline. You could be dollar hedged. So there's that element where you want to be somewhat active in all of these approaches. The sectors, the fixed income, to know what you own, know why you own it, and have it be based on where things are going in the next 6 to 12 months. On the real asset side too, we there's the commodity end of things, which, as we've seen since 2021, commodities have had a really good run, especially from coming out of 2020, where oil markets went negative and so forth. But this is a decade where there's going to be a lot of reward in doing active investing and staying on top and not just sitting passively. So 2010's passive was phenomenal.
So
The 2020s might change a little.
we talked about some of the things that we could be looking at and thinking about for our clients to hedge against inflation. But what you guys want to talk maybe just a little bit about some things that we could be thinking about, and areas that we could be thinking about that could be potential growth areas because of AI, right? When you've seen
Yeah.
semiconductors go
Yeah.
crazy. Go ahead,
Well,
Peter.
so yeah. Don't just despite the potential gloom and doom of our debt situation, don't think the U.S. is down and out, and don't sell short U.S. American ingenuity and achievement. In my career, I have witnessed two major technological shifts, as many people on this call have. The build out of the internet and the build out, and the whole smartphone revolution. And there are a lot of analysts, and I agree with them, by the way, that feel that the impact that we are going to feel from AI is going to be greater than both the internet and the smartphone revolution combined. Um, and I remember, I was a young stockbroker in the 90s, late 90s, and I was told that my job was going to be in jeopardy because of the internet, since people would be able to trade online. What would they need me for? In fact, I've we I've experienced the opposite effect. Um, it allowed me to leave a Wall Street firm and go independent, have access to all the data that was previously only accessible by these large firms. And as the internet grew, whole new industries have whole new industries and whole new and brand new companies were formed, and some of these companies are now the biggest companies in the world. Think of all the Mag 7 companies Jason's been referring to. But and speaking of the Mag 7, these companies are also referred to as hyperscalers. They have been investing and continue to invest trillions of dollars in artificial intelligence infrastructure. And the people running these companies are not dummies. They expect to get a return on their investment. So I think there's an opportunity by looking at all the sectors of the economy that will benefit from the build out of AI.
What could
And
some of
I think
them be?
low hanging fruit, I think, is healthcare and biotechnology. So AI is going to greatly compress the amount of time it takes to develop new therapies and new drugs. Also, when a company develops a new drug, they have to go through clinical trials. There are three phases of clinical trials to get an FDA approval. It
Yeah.
can take months or years to even get the trial going. AI is going to be able to sift through data and identify the best participants for these trials, and that will greatly compress the amount of time it takes to even get the drugs to trial. So I think there's a great opportunity there. I think you have great opportunities in stodgy industrial companies where we can see such efficiencies of scale be achieved by the application of AI. Um, and the naysayers say, well, think of what about all the jobs that are going to be displaced? And that might be greatly overstated. It might not be. But I think much like with the internet, there will be new industries that will come out of all this, and many of these jobs will be able to shift into new industries. So I still think the glass is half full.
Anybody else? AJ, Colleen?
Yeah, I agree with everything that has been said. And I think the most important thing is to know what your portfolio looks like and what areas are you invested in, and should you be tactical or passive? Do you have an advisor? You should, do some of your friends need help with this? And they talk about, I don't really know what I own. These are important questions now because now more than ever, we need to be looking at our portfolios and be tactical and have an advisor who's going to really be able to pull it all together and help you to get to where you want to be.
We can do the risk analysis software for anyone, even if it's a 401k that we can't manage, but we can certainly put things in there. AJ, what do you think?
Yeah, I mean, I think as you guys all, I don't want to repeat anything that you guys said, but I agree with everything that was said. And one of the things I'm excited about too with this diversification and broadening out of the market is, that value might actually do something again. We're looking at utilities and nuclear, which have both been mentioned on here, and these are areas that will benefit from AI. It's not just the technology like the biotechs and the computing. Obviously, that stuff is going to do great. Robotics, another thing that could really bring manufacturing back to us, but that all has to be built. And as I mentioned, we have an underinvestment in our infrastructure right now. And that's one of our big themes, which is what people say AI adjacent. So yeah, we're willing to analyze anything, any portfolio for anybody out there, and to give them our opinion on it and what they should do, if they should change anything or just continue where they are.
And as Peter alluded to, had mentioned before, that when the internet came out, that was his job in danger. People think the same thing now with AI coming. Well, what do we need an advisor for? Because we can just put it in and it's going to tell us what to do. Well, the one thing that AI is not going to do is help you to understand what you own and to guide you when the markets are down and you want to pull out of your investments because you're worried. Having an advisor is going to be there to help you understand your long-term plan and what would happen if you did pull out. That was the biggest thing that happened back when with the technology, 2000, help me out, 2002. And all investors pulled out of the market. Well, if you do that, you don't ever get an opportunity to recoup your losses. You can't just go into cash and hide there. So there were the biggest outflows in some of the passive strategies like the Vanguards of the world. They don't have anybody there to advise you. They are just order takers. That's not us. We are advisors to help guide you and to keep you invested.
Does anybody, there's nothing in the Q&A, I don't think. If anybody has any questions, you could pop them in there.
Yeah, you could funnel it into the Q&A. If you can't find the Q&A, you could also put it in through the chat as well. And yeah, I'll move to the next slide. So we could open it up for some Q&A if there's any. If there's not, no worries. Give it another minute or two.
Now, thank you all for attending. Oh, there's one. Yeah, so what international markets are you exploring?
So that's a good question. You want to have an allocation weighting to international, developed, and emerging markets. They're really two different markets that, it's not just picking one or the other. We don't pick anything country specific. That tends to be pretty difficult, and there's a few firms out there that have figured out, if you do it by which currencies you think are going to appreciate, you tend to get it correct. And we've used some of those funds, and they have one of the best emerging market space specifically. International investing in the large cap space, there's some camps where you can go with a pure blend. So that's, MSCI EFA, that type of investment approach. And you could do that either as local currency or dollar hedged, and you're fine there. When I say local currency or dollar hedged, either you're getting the appreciation of their currency with a local currency investment, or dollar hedged means you're just getting the returns from that market absent the currency effect. So some people have overweighted international value because when you look at large developed economies, they're very value tilted. So if you look at Europe, you look at Japan, look at Australia, there's a lot of financials, there's a lot of healthcare, there's a lot of industrial. So international value tends to be the better spot to invest in. Whereas in the US, it's been a US large cap growth story. So I would definitely get a little bit of emerging market exposure, probably one of the lower weights, and then getting some of the large cap developed. So that's international developed markets in the mix too. Latin America's been on a really nice streak. Some of the Southeast Asian countries have done all right recently. South Korea had a phenomenal year. last year. So there's definitely a lot of opportunities out there beyond just the US.
There's a
Yeah, I
question
think
about
Asia ex China. Since COVID, many entities have been diversifying their supply chains away from China, and that trend continues. So I'd say Asia minus China, and I also agree with South America.
Mhm.
there's a question about the increasing debt and how the really, I mean, it's in all iterations of government, and is there a thought about it ever becoming, oh, criminal? But I would think that that would have to be put into law, right? And it's the lawmakers that are spending more than we're actually bringing in, right? They're the ones that have to stop and increase our debt levels. Um, so
The hard part too is you need debt to grow. If you look at any successful companies out there, you want debt to grow. As nice as it is to have no debt on the balance sheet and so forth and being financially responsible, you grow faster with some debt in the mix. And the US from an actual balance sheet perspective, you look at assets versus liabilities, it's not a terrible, balance sheet. Um, a lot of these, spending bills and all that kind of stuff, there's definitely wasteful spending in there, but a lot of the spending is aimed at growing. And the thought process is if the growth occurs, the tax revenue increases.
right.
So that's the hard part where I don't know how you would break that down, especially because it's voted on, by a lot of people to get done. Like the COVID spending, if you didn't do that 2020, and they definitely went overboard, but if you didn't do that, you were looking at Great Depression era times. So it's definitely didn't want to add on 7 trillion, but it's the right move. I mean, bounced back pretty quick. Things got a little more expensive, but everybody wasn't out on the street. So it's a question beyond our realm or scope of knowledge, I'd say. Any other questions?
Thank you all. Thank you for being here. It's 12:57. We appreciate your time. Thank you so much for attending. Hope you have a great rest of the day.